Welcome to your weekly market overview, covering key economic events this last week. Let's dive into the top 3 stories shaping the global economy this week. Our first story, a big policy move out of the US. On July 12th, President Trump yet again announced a potential 30% tariffs on all goods from Mexico and the EU starting August 1st. Because nothing says help the economy like making everything more expensive. Trump claims this will protect US manufacturers and reduce foreign dependence. But let's be honest, we've heard this story before and it ended with higher prices, angry trade partners, and a whole lot of economic whiplash. The EU has already warned it might retaliate, and who could blame them? But they're holding off, hoping for negotiations. Markets, meanwhile, they barely flinched. Honestly, investors seem more desensitized to Trump's tariff threats than I am to hearing unprecedented every week. And of course, the Fed is stuck cleaning up the mess. On July 17th, Governor Adriana Kugler said the Fed's unlikely to cut interest rates soon because, surprise, tariffs make inflation worse. She predicts the PCE price index rose 2.5% in June with a core inflation at 2.8%. New York Fed's John Williams backed her up, warning that inflation could hit 3.5% by early 2026 if these tariffs stick around. But hey, Trump just wants rate at 1% or lower, because who cares about inflation when you've got elections to win, right? Not everyone at the Fed agrees though. Mary Daly from San Francisco is suggesting rate cuts might still happen, even 2 by the end of 2025. She says businesses are adapting and not passing costs to consumers. Cool. Maybe they're adapting faster than my patience. The Beige Book, released July 16th, paints a neutral to slightly pessimistic picture. Businesses are delaying hiring and feeling the weight of tariffs and immigration restrictions. So yes, it's not just in your head. It really is getting more expensive and harder to find work. Tariffs are acting like a shadow tax, one you didn't vote for and can't escape. Prices on imported goods, cars, medicine, electronics, all rising. Inflation might stick around longer than your New Year's resolutions. For investors, this means defensive sectors like healthcare and utilities may perform better. Tech stocks could see short-term gains, but if rates stay high and input costs rise, they're in for a bumpy ride. Bitcoin, meanwhile, hit around $120,000 on July 14th after reaching a high of $123,000. Because when the world gets weird, people flock to digital gold. Bottom line, Trump's tariff playbook might excite certain voter bases, but economically it's déjà vu. It's an expensive déjà vu. The Fed is trapped between wanting to support the economy and trying not to fuel inflation. And if things keep going this way, we're staring down the barrel of stagflation, slow growth, high inflation, and a Fed with few good options. Happy 2025. Okay, now let's take a break from tariffs and move over to the UK, where things, thankfully, are a bit more predictable. On July 16th, the UK labour market data came in pretty steady. Unemployment is still at 4.4%, but wage growth remains high, around 6%, which continues to complicate things for the Bank of England. The BOE is expected to cut rates in August, but this wage pressure might slow them down. That said, inflation has finally cooled and the overall economy is starting to stabilize, slowly but surely. Markets aren't panicking, and honestly, that's refreshing. If you're investing in UK equities or GBP, keep an eye on BOE signals, especially around wage growth and services inflation. The odds of a rate cut are still high, but they'll want to be sure inflation's truly under control before pulling the trigger. Finally, some good old-fashioned corporate news. No surprises, no drama. On July 15th, Novartis announced a $10 billion share buyback plan through 2026, following strong Q2 results and healthy free cash flow. They're focusing more on oncology and gene therapy, trimming lower margin divisions and doubling down on R&D. The market responded positively. The stock jumped 3.4% after the news. This is the kind of story investors like. Clear strategy, strong cash flow, shareholder returns, no tariffs, no central bank drama, just a solid pharmaceutical play doing exactly what it said it would. If you're looking at healthcare exposure, Novartis remains a reliable long-term bet, especially as they continue shifting toward high-growth areas in medicine. So, to sum it all up, tariff risks are rising and the Fed is cautious about cutting rates too soon. In the UK, a softening job market could push the Bank of England to act, and Novartis is booming, both in earnings and confidence. We'll be watching how these stories evolve, especially with inflation and growth pulling central banks in opposite directions. If you found this update helpful, give us a like and subscribe for more insights next week. Thank you so much for watching and stay smart with your money. Let's build the bridges and not burn them. Goodbye.